lakh crore bad loan load of Indian banks is now well and widely known. At the Edelweiss Credit Conclave, a star cast of experts discussed ways in which these over-leveraged companies could be revived. The experts included RK Bansal, Executive Director, IDBI Bank; Seshagiri Rao, Joint Managing Director and Group CFO, JSW Steel; B. Mahapatra, former Executive Director, Reserve Bank; Cyril Shroff, Managing Partner, Cyril Amarchand Mangaldas; H. Jayesh, Founding Partner, Juris Corp; Parth Gandhi, Senior Partner and MD, Aeon India Investment; and Conclave host, Rashesh, Chairman, Edelweiss Group. First and foremost, let me start with the strategic debt restructuring. Mr. Bansal, what's your estimate of the inadequacies of SDR? Do you think more needs to be done by way of changing rules?
I think the experiment which we have been doing with SDR, initially of course we were hoping perhaps it could work in many cases, but I agree with you, it has not really worked in many cases. I'll tell you the reasons. One is this so-called upside because of the SEBI price formula. It doesn't work. When there is a stress in the company, in any case, the value of the share is much low. There are other issues. I think the resistance to the overall change of the ownership, I think. The problem is we have called it change of management, but in India, strictly it becomes change of ownership. So the real resistance to that, so my feeling is it will work. It will work in a middle-sized company. It will not work in the larger projects, larger cases which are in picture. So there we need perhaps some other solution. And many bigger cases which are there, in fact, which we are talking of stress, whichever industry you are saying, they don't have SDR provisions. So we need promoters' cooperation to go ahead with SDR.
Okay, that really was my next question. Can it be done in a hostile fashion? Can it be done only if the promoter cooperates? Because after all, you need a resolution that the strategic debt restructuring will allow conversion of debt to equity.
Certainly. I mean, to pass those resolutions for SDR, you need the promoters' cooperation. The clauses which are there in existing cases, mainly in the earlier restructured cases. So actually, if you, whatever names you have heard in about SDR, about 15 to 20 cases, 20 cases, 90% of those are cases which were earlier restructured. So they have some sort of a provision in the system. But otherwise, the new cases which were not restructured, they don't have those provisions. So if we have to convert, we need the cooperation of the promoter.
Okay. Mr. Shroff, is it legally possible to force a hostile promoter, a non-cooperative promoter to convert? Does the law need to change? Do the regulations, notifications need to change?
I think short answer, yes, the law needs to change. And what Mr. Bansal said is true, that this is a result of a lot of legacy agreements and documentation, and that we are trying to superimpose a system that was subsequently evolved, and there are the gaps that need to be filled. So practically speaking, it's not possible to really give full effect to the SDR mechanism without the cooperation of the company and the promoter. But I just want to add one more insight into this in terms of really what is, and this is the perception, of what is driving the banks on the one side and what is driving the promoters on the other side. At this point, from a bank perspective or from the lender perspective, this is seen as somewhat of a soft option because it allows the postponement of how you sort of classify the assets. So it's a bit of a fudge, I think, intellectual fudge that's sort of going on.
No, not anymore. The Reserve Bank has told them to proactively provide 15% in the first year.
But I think it's at least certainly one of the drivers. And secondly, from the promoters or from the company's point of view, it's not seen as the worst case scenario because there's a lot of other scenarios that are playing on in the marketplace at this point of time, where there are far more severe consequences that can be visited. And compared to that, this is seen as a sort of a softer option. So there are enough drivers on both sides to cooperate. But to answer your question squarely in terms of can you force it? There are severe limitations on doing it. The law will need to change.
So what exactly has to change?
I think it will require effectively the ability to dispense with the consent, even in the absence of contractual provisions. Some of what theoretically can happen under the bankruptcy code may do away with some of these issues of seeking consent, because that's where legislation has stepped in. I'm
going to try and restrain you all from jumping to that, because first the act has to be passed. After that, all the intermediate institutions, the plethora of NCLTs, the tribunals have to be set up, the profession of investigating officers and agencies have to be set up. It does look like we are more than a year away from an ecosystem being created, considering that we don't have the bankruptcy code yet. Jayesh, what happens when you have an uncooperative promoter? I mean, won't he follow a scorched earth policy?
Most of the SDR cases are where CDR or JLF was sought to be done, and contractually clauses were embedded allowing conversion. Now, if you don't have that contractual ability, one other mechanism which used to work in the past, and I say used to in the past, like maybe well before SICA came in, was you take a company in winding up, then you don't need shareholders' consent. In the winding up, you present a scheme of arrangement where only the creditors matter. Where you're selling off the asset into a new entity, you create a new co effectively, and you can restructure the debt. In fact, if you look at the JLF circular before the SDR, it talked about possibility of transferring equity of the company by the promoters to the lenders to compensate for the sacrifices. We haven't seen those instances. Even when SDR was announced, for me it was a little baffling as to why are we not forcing the promoters to do an equity debt swap.
But Jayesh, you yourself answered your suggestion of winding up. It's not worked or is not working now.
In the recent past.
Yes, in the recent past. That effectively obviates, that removes that as a way of solving the problem. So we are falling back on SDR. So how would you rewrite the SDR rules or any other laws?
That is, Cyril rightly said that some change of laws is required. And one key thing which I think SDR didn't think through, and which now some of the banks are suddenly waking up and really worrying if not spending sleepless nights, is the promoter may have defaulted on PF contribution and whatnot other violations. And suddenly the banks are now majority owners. So their nominees will be directors. And, in India, the authorities love to go after the new guy in power.
What can you do to ensure that the promoter, that the sins of the previous promoter are not visited on the bank director?
Well, sounds like a very conceptual answer, but far greater coordination between the various arms of the government and therefore also the central bank. A lot of powers are already there, a lot of laws are already there. It's just the coordination and enforcement which is lacking.
I think that's a very relevant point, and that is why if you see initially there was a feeling, and as Mr. Cyril pointed out or Mr. Bansal pointed out, that bankers were thinking it is standard so I can keep it for 18 months. And borrowers were thinking, oh yeah, I'm owning the company also, and in any case banks will not take action against me. And now after clarity from RBI, I think banks are very clear, and RBI has advised us very clearly that the existing promoter has to go away. Initially that feeling was not very clear. I think that has also hit the STRs now. The other thing is, I think this problem about the statutory dues. So now we are very clear, we are going through a transparent process. Other agencies also came into picture in any case. So now we are going through an advertisement, we are asking bids, otherwise promoters were bringing their own people here and there. And we are ensuring most likely in most of the cases that if we exercise SDR, we change the management that point of time. We don't want to wait for 12 months or 18 months. We want to find a buyer first and then go through the process.
Mr. Rao, what changes are needed, and if you can predict when the first SDR transaction will happen?
In my view, the SDR mechanism, the way it is structured, it is too rigid. What we are finding today when we want to negotiate with the lenders, if anything which is a little different to what is written in the SDR mechanism, bankers are not taking a call on that. This is our experience. But at the same time, SDR is the ultimate. Ultimate in the sense, earlier you restructured or proposed to do something through JLR, all failed. That means management change is only way of doing through SDR route. Contractually, assuming that there is a possibility of converting debt into equity at whatever value that comes to, eventually the decision making has to change in the company. As Cyril pointed out, not only just change of control through shareholding or ownership, decision making also has to change, and the driver's seat should be who? From the day the SDR come into existence. That is also one of the important point. Otherwise, we are destroying value further wherever SDR has happened. We have seen companies coming or managements coming and handing over the keys to them that you have to now handle things. So therefore, SDR, in my view, if it has to be successful, before they take a call that SDR has to be done, buyer has to be identified, all terms and conditions are to be done. Contractually, they should be in a position to change the decision making to the new buyer, and flexibility to accommodate what the buyer requires, thereby value can be created. One more point I would like to add. For instance, assuming SDR is resorted to, subsequently the asset is sold to ARC, there is a possibility the existing promoter, which bankers are looking for change, he can buy again from ARC. That is to be blocked.
I think they've blocked that the SDR, that the company put under SDR is not brought by the same promoter or his proxies, but I guess the ARC angle also has to be looked at. Parth, anything you want to add to the process?
The problem in some of these companies, as I see it, as we see it, is currently equity value is very low, debt burden is high, and EBITDA is low. In order to convert to 51% of equity, you're going to convert a very small sliver of debt into equity. But the outstanding debt still remaining will not be serviceable by the EBITDA that has been generated. And that's a problem. So we need to think those through.
Those have been, analyzed, and the takeaways are with all of us. There are steel plants where if you after converting the minor sliver of debt into equity will be probably 30,000-40,000 crores, with the EBITDA probably 3,000 crores or even less, and therefore completely unable to service. But again, it would be the banker who would have to take the hit.
At any given point in time, you have to look at an asset and you need to say, what is the value of this asset today? It doesn't matter what you put in the ground. You may have put in 50,000 crores to create it, or 5,000. The replacement value is one way to look at it, and what is the going concern value is the other way to look at it. From an equity standpoint, you have to look at going concern value.
Okay, let me make it very clear. I'm here on behalf of the taxpayer and the depositor. I am not here on behalf of the promoter. So I generally want to know from all of you, is there any suggestion in the SDR so that the banker gets his money?
The fact is that a lot of the projects, for various reasons, either undercapitalized by equity, external world change, approvals didn't come, all of those, there is an inherent risk in that. And I do believe that if you analyze the entire stressed situation in India, a large part of this is project risk. And I think that is a fundamental problem of NPAs in India. To answer your other question, the risk is inherent. Some of the NPAs have happened. Now it is a fait accompli. Now, do you want to cry over that and recover every penny that is there, or do you want to be pragmatic and say that I've already provided for some, I'll provide some more, maybe I'll get some upside if economy comes back? I would strongly also recommend let's also be more pragmatic and say how to go forward, because Indian economy is risky and there will always be risk. The promoters will take risk, the banks will take risk. Unfortunately, in this current instance, we feel that the promoters have taken a smaller amount of risk with much higher potential upside, and the banks have taken a much larger share of the risk with much smaller upside.
Rashesh, actually that is my problem. If you're going to go and tell the banker, okay, you have 30,000 crore of debt, about 500 crore will become equity, and of the 30,000 crore, 29,000 crore you write off. The remaining 500 crore you become, look forward to the future when your probably 500 crore equity will become 1,500 crore equity. You're asking to take 29,000 crore hit. It doesn't make sense. From Bansal's point of view, it doesn't make sense to me. Does it make sense, Mr. Bansal? To take away 29,000 crore off, you think it still makes sense? I'm on your side.
No, it doesn't make sense. But anyway, let me come to one or two other points. I think as Rashesh mentioned, we used to do project finance. I also studied in that. And we used to have a convertibility option of 20% of the loan, which has worked well to some extent. And those days we had equity even in the greatest of the blue chips today. We have also gone through the first round of restructuring in CDR, and including some of the big steel companies which were restructured at that point of time. They all did well later on. Now that convertibility option, perhaps all the project finance loans should have. but somehow because of pressure from industry it was removed. The other issue is if a loan of this 30,000 crore, then certainly the problem is the equity value is so small that to own 51% itself you need, just in some company I did one SDR, I needed only 50 crore rupees. Now the debt is 1500 crore rupees, just to convert 50 crore to get 51% or even 90%. Now it's not going to reduce. So, but coming to that same point, that is why I am making that point. Today is not the right time perhaps to sell the steel plants. Of course, if the haircut is 29,000 crore, nobody is going to do. But certainly we can convert some into equity. Let us say convert 2,000 crore into equity out of 30,000 crore example which you gave. I can convert maybe 8,000, 10,000 crore into preference shares, which is a indirectly haircut, a deferred haircut. And then balance debt can be sustainable. The steel industry has an economic issue. I mean, the worldwide issue basically. It is not only, at least there is a plant, but there are many other segments where we don't have the assets. So we have to worry more about those companies.
Can I add?
Yes.
Because Latha is raising a point that banks have to lose money. Banks have to get back their money. Banks will get back their money.
Some money.
No, full money. I can tell you full money. But there is an example which I can tell you, which I want to share with you. Just I will take 2 minutes. There is a steel company in India in the year 2005 which was just sick. It was not operating fully. It had a debt of 1,000 crores. And then it was offered to us. So we went and said 600 crores is unsustainable debt. Balance 400 crores debt we will take. But 600 crores we structure in a manner that the conversion of the 600 crores at 60 rupees per share, within 5 years, banks have a right to convert, or a company can force conversion. Then 600 crores is not to be serviced, but 400 crores debt we will take. Existing promoter will sell its equity at 1 rupee per share. Market price was 8 rupees at that time. Banks have agreed. If conversion is not exercised within 5 years, retrospectively this loan will carry an interest of 12.5%. This is the structure. We took over the company and we turned around and the share price went to 100 rupees. Banks have converted, made full money, company has not serviced. My only point is, as long as SDR provides flexibility to have this type of structure, still it is possible. Therefore, banks won't lose money. Whatever conversion that is taking place at a higher price, if banks feel it is a haircut, it will never happen. Therefore, any prospective buyer who has a plan to turn around the company, if that can be done, if it is workable in the view of the lender, if this type of structures is possible, if it is a part of SDR, I think it is possible for the banks to recover entire money. The mindset today is by converting into equity at a higher price than the market price, they lose money. Or somebody will point out, or CVC will question, CBI will be after them. These are the problems which the bankers are facing. The buyer has no flexibility today to have any structure. I feel this should be there.